Hi, my name is Daniel, and you're watching Unrivaled Investing. I wanted to walk you through my current thoughts on the investment climate by looking at it through the lens of 4 different companies. We're talking about Berkshire Hathaway, Apple, Bank of America, and Brookfield. These are major multi-billion-dollar businesses. We're going to start with Warren Buffett's Berkshire Hathaway, which just reported their third quarter earnings. When you look at their earnings, very high level, looks fantastic. Their operating earnings increased by over 50% year over year, in part by better insurance profitability, where they said, hey, we got to make sure our Geico auto insurance that is profitable. There's no reason that it shouldn't be, and they're benefiting from higher interest rates. As cash yields a higher yield, they're able to get a better investment income. That said, their railroad business and utility businesses were both lower year over year. And so overall, I look at their net earnings, and it was actually not as compelling when you start factoring in these things, as well as a sizable loss in their investments, where Berkshire Hathaway's investment portfolio declined by over $20 billion in the most recent quarter, causing their total net earnings to go negative. When you look at what Warren Buffett has been up to, you can actually see that year to date, he's actually been a net seller of stocks. He bought around $10 billion and he sold over $30 billion. So let's say a net seller of over $20 billion in stocks. And he did do a little bit of buying for, buying back his own stock, around $7 billion. But still, even net of that, he's been a seller. And he's been building his cash pile, now around $170 billion plus. So you're looking at, an investor that by no means do I look at this and think, oh, Warren Buffett's finding lots of opportunities. We do know that, he bought some oil companies in the past, but overall, he's been a net seller. Now, let's look at 2 of his largest holdings that represent over 50% of his public investment portfolio. That's Apple and Bank of America. You look at Apple stock, Apple recently reported their 2023 earnings. You're seeing a 3% decline in revenue. You're looking at a decline in earnings. You're looking at a decline in free cash flow. Despite this, it still trades at around 27 times earnings. When I think about, what's the range of potential returns over time, this is via AI Ticker Chat, which is free for the first month. So check that out in the link below, and leveraging AI to sort of get a range of what could be the revenue growth in the years ahead. What's the profit margins? What's the end multiple? It really isn't that compelling. And this is for across all U.S. stocks above $300 million market cap. You can get this sort of framework leveraging AI, and it's just not, up 40%, down 50% if you have some sort of valuation reset. So I don't look at Apple when it's reporting, a decline in sales, a decline in profitability, but earnings per share went up because they bought back a lot of stock. I don't look at that as an extremely compelling setup. I'd rather have something with strong organic growth going forward with that buyback. And, maybe that'll be the case going forward. We'll see. But I'm just not seeing it here with Apple, especially with its current valuation. Look at Bank of America. The last 2 years, it's lost nearly 40% of its value. So there's clearly a red alert going on here with Bank of America. I mean, this is one of the largest banks in the world. You shouldn't see it trading like this unless there's some sort of signal, especially when you look at it and you go, wait a second, they're reporting strong results. They're saying earnings, is up over 10%. They're talking about book value growing nearly 10%. And yet it trades at under 8 times earnings. So Warren Buffett, this is his second largest public holding behind Apple. So Apple's around 50%. Bank of America is around 10%. So either Bank of America is just, a once in a lifetime opportunity trading at 7-8 times earnings, it's an incredible bargain, or there's a big problem here that investors are just starting to wake up to, and that Wall Street's starting to price in that investors should be mindful of, because oftentimes you have pricing lead the underlying fundamentals. So there's a question of, well, what's potentially the problem here that's causing Bank of America to sell off, or what's sort of the signal here? What are my underlying thoughts? First of all, in full disclosure, this is not financial advice. Also, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for premium annual subscribers. That's at unrivaledinvesting.com. So let's talk about Brookfield. I'll go back to Bank of America in a second, but let's look at Brookfield. They are one of the largest asset managers in the world. They manage over $800 billion. They also have their own entity called Brookfield Corporation. So I don't want to confuse folks here. I've written about this with greater detail at unrivaledinvesting.com. I also did a prior video for public on YouTube about Brookfield. Two separate entities, but they're largely owned by each other, where you have Brookfield Corporation that owns investments for themselves. So you can think of, they own this asset manager, and this asset manager is also publicly traded. This asset manager manages $800 billion plus. Across those assets, they've also said, you know what, we want to cherry pick the best things for ourselves that we're going to own. And that's also owned in Brookfield Corporation. So, how to think about, so they have these vehicles that they manage, as well as investments that they directly own for themselves with Brookfield. And when you look at it across their various different vehicles, you could see that they own over $20 billion worth of property. 14 billion in core, 8 billion in transitional and development, of which they're saying the annualized free cash flow for their core properties is under 500 million, and the annualized cash flow for this other properties is under 200 million. And the reason why that's super important for you to know is Brookfield is saying, hey, we own property, and this is, you would think, the best property out there among their various different $800 billion plus of investments that they've chosen to own for themselves. Those properties, those investments, those vehicles that they own, they're saying the free cash flow yield on that, they're marking it based on the figures I just showed you at effectively a 2 to 3% yield. Now, the question is, this $20 billion in property versus $500, $600 million in cash flow, that's how you get this 2 to 3% yield. Does that make any sense when you can get nearly 5% on cash? I personally keep my cash at Interactive Brokers. See the link below. Does that make a lot of sense? Or does that mean that you're going to be seeing more pain to come? And I think that's partly why this ties back to what we're seeing with Bank of America. Why does Bank of America trade at 7 to 8 times earnings? I think a lot of folks are saying, wait a second, you're going to have major institutions, major investors like Brookfield that hasn't yet properly accounted for the pain that you should mark with higher interest rates. If you have cash yielding 4 or 5%, stocks, in theory, the earnings yield, unless you have fantastic growth, should probably be around 6, 7, 8%. And debt and real estate, private equity, should all have some sort of mark that's tied back to, hey, what sort of premium should you get above that 4 or 5% that you get on cash? So that hasn't been yet reflected, at least with Brookfield Corporation's, asset, where they saying, hey, this is our property that we own. They're saying, hey, we're still marking it at a 2 to 3% yield. And you might have this situation where a lot of banks are going to effectively get pushed back and say, hey, we're, the owners of a property are going to say, hey, we're not going to refi this unless you restructure our bonds, unless you restructure this debt. And I think the Bank of Americas of the world, and it's not just them. You look at all these regional banks, a lot of them are trading for, 50 cents on the dollar, at book value, or 40 cents or 60 cents, huge discounts relative to their reported book value, because of this uncertainty of, will you have significant adjustments that haven't yet been priced in? And this is part of the lag effect of raising interest rates, is how long, do you have to, can you take until you realize reality of this? Oh my goodness, this property is no longer worth a 2 to 3% yield like Brookfield is marking there, which is a concern. So I think you're looking at a few different, and I think this is why it's super important for investors that are, saying, hey, I'm actively buying, right now, or, I'm a mega bull, or I think, we're in a new bull market. I don't think that's the case. And I think you're seeing a lot of data points here, looking at each of these different things. Let's look at Buffett. Buffett's a net seller. He has a huge cash position. Sure, he bought back a little bit of its stock, but not a lot. He did not use his elephant gun to buy back a lot of stock. He bought $7 billion. He could, if he really thought it was compelling, he could probably buy $40 billion if he wanted to, maybe even $50 billion in a year. So by no means are you seeing strong conviction from arguably one of the greatest investors of all time, Warren Buffett. You look at Bank of America. Bank of America is clearly sending some sort of signal here that there's a problem either going to happen, or it's just an incredible opportunity. I personally look at it as there's some sort of issue here. Why it's down 40% in the last 2 years. And it goes back to Brookfield. Brookfield, saying, hey, our properties are worth a 2 to 3% yield on free cash flow when you can get 4 or 5% on cash. That doesn't make sense to me. And so I look at this and I think the pain, the repricing hasn't yet happened. And I think we're getting closer to that point the longer rates stay where they are. You look at Apple trading at a high 20s times earnings multiple for declining revenue and profitability. That doesn't make any sense to me. I think that, and one of the largest company in the various different indices, I look at that as a negative, another potential headwind. So I look at all these different elements. Should you, stop buying U.S. stocks? Every investor is going to have their own, journey. Some people like to, buy every week, every month. I personally prefer a more opportunistic approach. I prefer to say, hey, is this really compelling right now? Maybe it's sold off 50% in the past month, and a large part of the thesis is there. It's just the valuation's cheaper. So I think you need every investor is going to have a different journey. I'm personally more cautious when I see all these different data points. This does not, seeing Warren Buffett being a huge net seller, seeing Bank of America trade where it does, these are red flags that investors should be mindful of. And I do think that there are better opportunities than these mega companies. Like one of my largest companies is an insurance company. One of my largest bets, and I've called out to my subscribers, it's up over 100%. And I still think it has another 100% plus to go, partly because the environment has become so much more favorable for certain insurance companies. Because now with interest now yielding something, if you have a large cash portfolio, hey, your investment income, as I showed with Berkshire, is significantly better. So I think there's a lot out there, but you should be careful about what you're investing in right now. And I think looking at banks, for me, I see some investors. Bill Gross is a famous investor. He recently said that he's finding value in regional banks. It gives me great pause when I see that some major investors across various different assets are still marking their assets at a 2 to 3% yield. If you have a different opinion, I'd absolutely love to hear it. I'm not trying to be a fearmonger. I'm trying to share the various different data points. I mean, look, if Berkshire was just posting fantastic results across the board and Brookfield was marking their real estate at an 8%, and I'd say, wow, maybe this is really great. Maybe there's an opportunity that they're being conservative with their marks. So I think it's important to have a realistic appraisal. And that's what I'm trying to do here. If you have a different opinion, I'd absolutely love to hear it in the comments below. Please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.